So I'm going to be today talking, as we said, a switch of geographies really, and sort of looking at Asia more as a source of income, as a potential sort of diversification away, if you like, from traditional sort of more UK-centric income opportunities, as well as sort of really touching on what's sort of going on, briefly at least, in the region and some of the main themes that are driving that. So if we just look at this slide, what this shows you is really an important point, which I think when we generally think about sort of Asia, we tend to think of a sort of a high growth region. We perhaps don't necessarily think about the sort of dividend opportunities that are out there. And we don't actually think about the amount of total return that has actually come from the reinvestment of those dividends. So this chart just shows literally the total return of the index over time, which is the dark blue line, against the price return. And you can see that sort of well over half, nearly 2/3 of the total return over the long term has come from that reinvestment of dividends. So clearly, income has been an important consideration from a income perspective. The other thing I wanted to do is just to sort of illustrate where sort of dividends in Asia approximately sit compared to that of, say, the UK. So if we look at the chart on the left here, what you can see is the light blue line is the yield of the Asia Pacific ex-Japan region, and the green line is that of the UK. Historically, the yield, and the other line is just to say is the base rate in the UK. And you can see that the blue line, which is the Asian yield, has generally been slightly less than that of the overall UK market, but still a pretty reasonably healthy yield through time. And then how does that then compare against the rest of the world? Well, if you look at the chart on the right, which just literally again compares Asia yield to that of the world index, you can see that it, on average, over the last sort of 20 odd years, it's traded at about a sort of 30% premium, or so 130% of the level of that of the world index. And at current levels, it's actually trading relatively attractively versus its history, being sort of over one standard deviation above that longer term return. So on that basis, sort of Asia, from an income perspective, certainly looks an interesting proposition. On the next slide, I just really put in a slide here to try and just sort of convey that opportunity set. And I think what's particularly important about this for me, but in the way that I manage the trust, is that it is very much a sort of a bottom-up fundamental approach. And I'm very much buying companies on a stock-by-stock basis. And so having a wide opportunity set is important to me when it comes to income. And so the left-hand chart here just looks at the proportion or the number of stocks that make up 50% of the income that come out of the UK, and comparing that to Asia. You can see the green bar, which is the UK. It's just under 10 stocks that make up roughly half the income. Russ alluded to that or mentioned that in his earlier presentation. But when you compare the same number to the Asian index, you can see that the number is more like just over 35. So again, for me, as an active stock picker, a good opportunity set. If you look to the right-hand chart, again, I think this just points to the fact that it's a wide universe of companies that are out there that have got decent incomes. It just looks at the proportion of companies with a yield over 3%. And Asia, which is the sort of the lighter green line there, you can see it's sort of approximately the same as that we see across Europe. It's roughly about 60% of the companies yield over 3%. So again, a relatively deep bench of stocks which we can choose from. And the following slide has really put in here really just to sort of amplify or to sort of illustrate what has happened over the last 3 years with regard to growth versus value. Obviously, income is very much a value factor, and therefore has performed more similarly to value than to growth. So the dark blue line here just looks at growth versus the Asian index. So when the line's going up, that means it's outperforming. When it's going down, it's underperforming. And similarly for the value, which is the light green line. So back in 2020, everyone wanted growth. They were willing to pay high multiples for long duration assets, anything which could potentially be growing out into the future. Whereas value stocks tended to be much less popular just because of the low visibility on earnings and where growth was going to come from. That all obviously reversed as vaccines became available, or started to be at least thought they would become available, and obviously as inflation and interest rates started to move up. So value has since outperformed. Over the last year, it's been much less pronounced, but still there has been a modest outperformance of sort of value over growth in Asia, much similar to much of the rest of the world. I think, and during that period, obviously, towards the end, we saw more of a recovery come through in earnings, and that led to dividend increases in 21 and through into parts 22, and then if we look at the up and coming chart, which basically looks at sort of where dividend growth is projected to go for this year, you can see that the chart on the left, and this just uses consensus numbers for the region. You can see that sort of the growth there is sort of basically flat for the region as a whole, but there's quite a wide distribution of growth in dividend or degrowth and where it comes from. And I think and obviously one of the drivers that leads to dividend growth is obviously earnings. And what we have seen in Asia over the last year is that we have seen earnings being revised down during the course of the year. And that can be seen on the sort of, if you like, the snail trails on the right-hand chart, which basically show revisions down coming through to earnings. There is, as we look at the sort of dark blue line for 2024, it looks like we're going to see a rebound coming through according to consensus. But for now, the earnings momentum it remains under some pressure given the sort of outlook for global growth. If you look at the sort of left-hand chart again, I'd just go back to just highlight a couple of things about where the sort of weakness in dividends has sort of been seen. It's been mostly seen in those sort of energy and materials sectors, which is not a surprise given what has happened to sort of commodity prices and how they're pulled back, which has obviously impacted earnings of some of those companies. But in most other areas of the market, actually, we can see some sort of growth coming through. And the other thing to mention, I think, is really that sort of Asia from the perspective of balance sheets and ability to pay dividends, I think still looks pretty comfortable versus its history. So the left-hand chart looks at trailing earnings, which is the dark blue line, and dividend payout, which is the light green line. And you can see that the light green line, which is essentially the payout, so the proportion of earnings which are being paid out by companies, is roughly around that 40% mark. So still, not that elevated, and certainly sort of comfortable within the sort of historic range that we have seen. And the other point is that sort of Asian corporates in general tend to be less well geared, so tend to have less debt in aggregate on the balance sheet. And you can see that from the right-hand chart, which looks at the net debt to equity. And you can see for the sort of the lighter green line at the bottom, you can see Asia, all countries Pacific ex Japan, is generally much less geared than in aggregate than that of most other regions globally. So again, relatively less stress, if you like, from a balance sheet perspective there. So they were the sort of comments I was going to make around sort of dividends and from an income from an Asian perspective. I just wanted to touch on a couple of sort of more sort of macro comments about what's going on in Asia at the moment. Obviously, China at the moment is an interesting case point because it obviously left its zero COVID policy behind at the end of last year. And that has obviously implications for both the economy and the stock market. And I should say at this point that from an allocation perspective, I am underweight in China. And I think that I should just point out a couple of reasons why I think sort of actually the sort of, if you like, you can almost call it the sort of recovery playbook that we saw in sort of the US and the UK is a little bit different when you view it through a sort of Chinese lens, if you like, from the move away from zero COVID that we've seen there. And that's that left-hand chart, which you can see in 2020, which just looks at retail sales. But in 2020, obviously there was the impact of COVID came through. Retail sales were generally weak. But if you remember, obviously China was slightly different from everywhere else. It managed to sort of close its borders and open up its domestic economy so that it operated not normally, but it certainly was operating more normally than most other places. And you can see that there was a good recovery in retail sales. It was only really when Omicron came through later on in 2022, really, that we started to see a much bigger impact with the rolling lockdowns, etc., that you'll be familiar with. And now, obviously, that's with the authorities obviously moved away from that zero COVID policy, and we've started to see things recover. The other difference, which is that middle chart, is really around the sort of savings ratios of the US compared to China. The US, obviously, when we went into COVID, people obviously weren't spending as much. Also, they were getting payouts from a social security perspective and other reasons, which meant the savings rates went up. And that didn't really happen so much from a Chinese context, given what I was saying about the economy being still operating to a large extent. And when sort of the US and other economies opened up, they basically saw people coming out to spend more and drawing down on those savings. That's less of a sort of factor when it comes to sort of what's going on in China. And all that's sort of translating through to a recovery in growth in China, but not perhaps as strong as I think sort of some of the original expectations were for growth. And you can see that from the Q1 GDP sort of breakdown of data on the right, which shows that, you know, as with here and elsewhere, that, you know, obviously the strongest areas have been around services, hotels, catering, that sort of thing. But rather the demand for goods has not necessarily seen that strong a recovery. And the other point about China, just to say, is that there's obviously a couple of headwinds around sort of growth, which are out there in a sort of slowing global growth environment. You're going to see exports obviously being a bit of a headwind in the sense of the ability to grow them. And at the same time, as you'll be aware, the sort of Chinese property market has been sort of a source of weakness for the economy. However, what I do think is positive is that the measures which the authorities have come out with to sort of stimulate that area, and also the move away from zero COVID, should mean that we can move away from sort of some of the more pessimistic sort of forecasts around Chinese growth. So we're starting to see a bottoming out of that market, which is positive. Clearly, quite a few other areas within Asia will benefit from that recovery or opening up and then the zero COVID policy. China, obviously, you know, historically has made up quite a large proportion of tourists, for example. in other countries and other regions, and you can see that on the right-hand chart there. So as people open up and mobility increases, that will obviously start to feed through to some of these countries. And if you look at this chart, you can see what the impact has been on the likes of sort of Hong Kong. So essentially, this just looks at the visitor arrivals into Hong Kong over time, and you can see when COVID came into play, there was basically the borders got shut, there was a long quarantine periods, and essentially all visitation for practical purposes stopped. With the opening up now and the sort of move away from quarantine and so on and so forth, we're starting to see the mainland Chinese visitors start to return to Hong Kong, and you can see that starting to tick up, and we would expect that to continue, and that to help support Hong Kong from an economic perspective, and also improve the outlook for a number of the companies there. And within the overall portfolio, I continue to like Hong Kong. And here just gives you sort of a feel for the sort of valuation distribution across the different countries in Asia. It just looks at the PE valuation, so the price to earnings forward for each of the markets and where it sits within its historic range. And so you can see, for instance, China looks, it looks reasonable value on this. What we would say is that sort of the valuations basically perhaps that have historically applied to China don't necessarily apply to all companies going forward, just because of the change in sort of, or the extra regulation that we've seen in a number of industries there means that you're going to see the earnings power of some of those companies impacted, which will mean that they should trade at slightly lower valuations. But however, markets like Singapore, Hong Kong do look attractive on here. Korea looks relatively expensive on here. I should make a point about that. That's really because it's more of a global cyclical, quite an early cyclical, in the sense that it's quite exposed to sort of semiconductors, and semiconductor demand has been weak. And that has seen technology companies or hardware companies that have been under pressure from rising inventories. More recently, that has started to, the demand supply outlook has started to improve. So we have seen announcements of production cuts and capex cuts for some of the semiconductors companies in Korea, for example, and that starts to address that sort of demand supply imbalance. And valuations, I think, there look attractive, particularly on a longer term basis in some of the sort of technology areas. And so again, we remain overweight in some of the technology companies. The other area where I think, from a macro perspective, you should just be cognizant of is that sort of inflation's been a bit less of an issue compared to the rest of the world in Asia. So that's the chart on the left. You can see that Asian inflation has fallen pretty rapidly. That's because it's largely been driven by goods inflation, which has been coming off a lot. It has much less of a sort of wage inflation problem because there's been more slack in the labour market there. We didn't really see sort of reduction in participation rates and so on that we saw elsewhere. And historically, if the US dollar starts to weaken, actually that generally has been a relatively supportive for Asian markets historically, and that's the chart on the right. Bit busy, I know. The green chart line is the US dollar index. When it's going up, the dollar is strengthening. The blue line is the Asian index when that's and you can see that sort of in the 90s, late 90s, as the green line moved up, Asian markets generally underperformed, so the dollar was strengthening. And when they weakened in the sort of through the 2000s, the Asian markets historically have done well. And there's the broader valuations, which not really much to add to that. Looks generally pretty good on it doesn't look a problem on a longer term basis. And then sort of a summary just on the sort of things that I've been talking about. Clearly, some of the concerns over sort of interest rates, inflation, some of the geopolitical side of things, but Asia as a source of income definitely is there as a sort of an ability to generate an income for shareholders. And then, if just touching finally on the Oriental Income Fund, this is obviously we're trying to select some of the best income ideas from across Asia. It's very much a sort of bottom up. Sorry, gotta just. So just from a bottom-up perspective, so to help us do that, we've got a team of analysts who are based out in the region, who go out, visit the companies, and I draw on their best ideas from an income perspective to construct an active portfolio. And you can see from the portfolios obviously generated good absolute and relative returns over most periods. From a distribution perspective, it has increased its dividend each year, and currently it's yielding around about 4.5%. One thing I should be clear on is that one thing that does impact the direction of dividends for UK investors is the strength of sterling. So if the UK sterling is strong, that is a bit of a headwind, and if it's weak, that tends to be a tailwind to dividends from the perspective of income. And with that, I will bring my presentation to an end.